you guys are actually here, because we know that you guys could be doing anything with your time, and it's really valuable that you guys are taking this into your own hands.
100%. Thank you guys so much for being on this call. We truly appreciate every single one of you. You know, we do this for you guys, so thank you guys again.
All right, so we're going to start off this call with something really important. One of the biggest problems we're seeing during these one-on-one calls is people aren't understanding how to calculate the proper lot size for their account. So what we're going to do today is Professor O is going to show you guys how to calculate the lot size for your account, how to not over-leverage, and how to risk the proper amount, which is going to be major key for you guys. All right, let's go ahead and get this started.
You guys, this is very important, all right? This is very vital, okay? And it goes with, it ties into our signals, all right, you guys? So for example, if you get a signal sent to you, this is something you should be calculating, you know, your risk management, all right? You should be able to see if this trade fits your account size, okay? For example, if we send a signal, you know, you look at the entry price, and that entry price, say you missed it, we called the signal 5 minutes ago, for example, and price dropped, and you're looking at price, and the entry price is different from where price is at now, okay? You can take the signal, you can take the trade there if your risk management matches with your account portfolio, okay? So let me show you guys what I mean. All right, so we're gonna draw up some examples, and I know I've done this with you guys on the one-on-ones, all right, but it doesn't hurt to do it again. And again, this is very, very vital, all right? The reason I say this is because the best way to gain money is by not losing money, okay? So right now I'm gonna show you guys how to properly calculate your position, all right, how to properly calculate your risk for each trade. All right, so we're gonna do a couple examples, and I hope you guys bring out a calculator and do it with me, or pen and paper. Awesome, so we're gonna do an example with a $300 So for a $300 account, you guys are risking 2%. Okay? That means you could only be risking $6 for every.
Omir, good night.
Hey, how are you?
You? Okay, we can hear you now, hon.
Was there a problem with the audio before?
Nah, but when he came on, it just went down low.
I apologize for that. So, you said as soon as I came on, it went down low?
Yeah?
Okay, to reiterate what I said, essentially, I was talking about how position sizing is very important. Okay, so right now I'm going to be showing you guys how to properly assess how much you should be risking on each trade. Okay, and I'm going to be doing that with a $300 account. All right. Okay. The signals come without Althea, we apologize for that. We will definitely be sending the entry price for almost every trade. We will definitely be sending the entry price for every trade. Okay, that way you'll be able to see if you know how far price is from entry. Okay. But again, going back to calculating your position size, I'm going to be doing it with a $300 account. All right, and if you're risking 2% on your account size, okay, for a $300 account, we should only be risking $6 on each trade. All right, you guys. So we should only be risking $6 on each trade. And for this trade to be enticing, we have to be looking for at least $12, $18, or $24. Okay, so we're looking for a 2-to-1, 3-to-1, or 4-to-1, all right? So 18 or 24. Awesome. All right, so what does this mean? All right, we should be risking $6 on every trade. All right, so there's two ways about doing this, okay? And that goes with the pips and the lots, okay? Okay, so for example, so if we're risking $6, you guys, we can be risking 30 pips, okay? If we are using a 0.02 lots, okay? So what does this mean? All right, you guys, and all you have to do is move the decimal 1 to the right, okay? And for example, now we have 20 cents, okay? So we're getting 20 cents for every pip, okay? So 20 cents times 30 pips, you guys, is $6. Okay. Okay. Or we can do 15 pips. So this is the stop loss. This is our stop loss. This is how much you're risking on each trade. Okay, 30 pips or 15. Okay, and here, instead of a 0.02, we can put a 0.04. All right, and the same thing, we move the decimal 1 to the right, you guys, and we get 40 cents a pip. Okay, so 40 cents a pip times 15 pips is again $6. All right, you guys can see with two different positions, two different lots dropped, we are still risking $6 simply because we decreased our stop loss. We decreased our pips. Okay, so there's two ways about doing this. All right, you can either go big on your lot size, but you have to decrease your stop loss. Or if you want to go small on your lot size, you can increase your stop loss. And you guys can see with a $300 account, there's two ways about risking 2%. Okay, so we're risking 2% on this trade. All right, so again, we have a $300 account. All right, we're risking 2%. Okay, so that's $6. And we can calculate this by multiplying our pips times our lots. Okay, so we can either have a wider stop loss for a riskier trade, for example, like the pound pairs or commodities like gold. All right, but we have to decrease our lot size. All right, and if we want to increase that lot size, we have to decrease our pips. Okay, so we have to decrease our stop loss. All right, and again, we're risking $6 for each trade, which is 2%. Okay, and you can do the same exact thing for whatever your account size may be. Okay, so this is important when you get signals, you guys. All right, say we send a signal and the stop loss may be a little bit higher than your associated risk position. Or maybe we send the entry price and you check back 30 minutes later and price isn't where the entry is. Okay, you can take the trade if, again, that stop loss is associated with the correct position on the account. Okay, does that make sense, you guys? So again, what we did right now is we calculated our position size. Okay, so we're risking 2%. So again, we have the amount on your account. Okay, you risk 2% times 2%. You get the actual amount you should be risking. Okay, which again is $6. So we can risk $6 by going two different ways. All right, even if we drop a if we do 60 pips on a 0.01, and again we just move the decimal 1 to the right, so that would be 10 cents a pip. Okay, so 10 cents a pip times 60 pips is still going to be $6. All right. So you guys can see there's multiple ways to calculating your risk. All right, just keep that in mind. And this is very important, all right, because the best way to gain profits is by not losing profit. So you should know every time this trade gets to $6, there's no reason for me to be in it any longer. All right. So other than that, if you guys have any questions, awesome. So I'm gonna hand it back over to Mr. Pipster. He's gonna finish up this mastery call for you guys. I hope you guys are ready for some heat.
All right, what's going on, everybody? So that was some serious fire. That's one thing that I want you guys to really pay attention to. And so Professor O said two things that were extremely important. The first one is that it's important to calculate this before your trades. So I really want to touch up on that. This goes into the mindset thing. So we're always talking about trading without fear. That's, trading in the prime zone and the most just fluid state where you just feel confident and you're not worrying too much and you can just execute trades flawlessly. The only way that you can trade without fear, guys, if you're accepting the risk of your trades. So if you accept how much money you're going to lose, so if you do the calculation, it comes out to, let's say, $6 risk, or let's say $12 risk. You have to ask yourself before you enter every trade, am I willing to accept a $12 loss? Now you guys are asking, do I have to do this for every single trade? Like, guys, this is your money on the line. Okay, if you're not going to do this when your money's on the line, when are you going to pay some attention? Okay, so all it takes is maybe 15 seconds. You just multiply the amount of pips by the lot size. And eventually, guys, the more that you trade, the more you become comfortable with this. What's going to happen is become subconscious. So you can just look at the numbers on the side. So gold is my favorite because the numbers are so even. 1420 to 1440 is 200 pips. Like, I know this. And so, you know, with these types of calculations, I just know, okay, if it's from 1440 to 1420, I have to risk this much pips and this many pips, and it's just all clear to me. So this is something that you get better with in time, but you have to do this before every trade, guys. And when I get on a one-on-one with you and I ask you if you're trading without fear and you say no, I'm going to ask you if you're over leveraging or if you're accepting the risk. And I guarantee it, the answer is going to be no. This is the single game changer for you to be able to trade confidently, which is knowing exactly what's on the line. So when you walk away from the computer and you close it, you know that only $6 can be lost and nothing more. There's no surprises. Surprises is what causes fear in the market. If you know that anything can happen and you're willing to accept how much money you put on the line, you should never have a single doubt. All right, now let's get into the actual charts and I'll show you guys how we can, Command Z. I'll show you guys how we can calculate this using the tools that are given to us in TradingView. So over here, guys, we have the short position tool, and I'll show you guys where to find it. It looks like this. All right, awesome. So if you guys go to your drawing panel, it's going to be right here, okay, on the side. It'll be long positions and short positions. Short positions, as you guys know, means sells. Short, sell, SS. You guys keep that in mind. And long position means buys. And I think I know where they got the names, because when you're buying something, it takes a long ass time to make your money. And when it's shorting, the market just seems to drop. But you guys can see it right here. It does the calculations for you. So this top number over here, you guys can pay attention. It says stop loss. And the stop loss is 32 pips. Okay, so the TradingView will actually do this calculation for you. You guys will never actually have to multiply these pips, and except to figure out how much you can risk on your own account. But the pips risked is always right here. So that the hardest part of the calculation is already done. And then your take profit is down here, which is 250 pips. So this is a risk and it shows you the risk and reward ratio 772 or 7.76. So it's all the math is done, guys. All the guesswork is done. If you know that it's 30 pips, and you go over here, and you know that you can only risk $6 on your account, you know that you need to throw a 0.02 lot size. Okay. A lot of the problems that I've been seeing when I'm on the one-on-one calls, guys, is some of you guys had a bad foundation where some of the people that you were being educated by were advising you to make quick jumps in your account by over leveraging. The beauty of that is that sometimes you make a lot of money, but then you're going to blow it at some point. The market is not perfect, and as you increase your confidence, quote unquote, you start to increase your lot size when your account simply can't handle it. You guys see, some of you guys have a $300 account and you're throwing 0.1s. You're missing a 0 in front of your lot size. And so that's something that I've been finding is if you're going to take our signals, we're going to lose 3-4 signals. It happens. If those 3 or 4 signals blow your account, guys, we can't be responsible for that. You're not applying proper risk management. So these are the proper risk management principles that you guys should be applying. It's 2% of your account at any one time. And you can use this tool to measure the trades. What you would do is you would put your entry point right in the middle. You would put the previous high up here. And then you would put your take profit at the extension levels. We use Fibonacci's here, so you guys can gauge this in a different way. If you guys get on a one-on-one call, I've actually advised people to use different strategies according to what works for them. So if you guys are actually comfortable with Fibonacci retracements, I'll actually tell you guys how to use those for support and resistance. If you guys are more comfortable with standard price action, I'll show you guys how to look left to find areas of support and resistance for confirmations. Okay? So let's go through some of the trades that we called this week, guys. I think part of the market mastery course is I want you guys to answer the questions. All right, there's no point in us talking because I feel like that's just going to give you guys the same thing that we've been saying the entire week. And so the only way to actually get you guys to engage is that thing that our professors in school used to do, which is make us do the work, even though it's annoying. So I'm going to show you guys a series of things. We're going to draw out some anatomy of some different patterns. And I want you guys to put in the chat what's going to happen next. Is it going to be a buy? Is it going to be a sell? Is it looking to consolidate? All right. This one's really easy, so
If you want,
I'll get this up.
you can delete it if you want. The whole chart, clean it up.
Oh, perfect. All right, guys. So we're going to go and back test these things. And I'll show you guys a backtesting strategy that you guys can use just to test out any strategy. Okay. So let's say that you have a trading system that you're now willing to adopt. So let's say it's a break and retest strategy, or it's an engulfing candle strategy. The engulfing
excuse Roy.
Yes, Nikki.
Your volume went down, hon.
again. How about now?
Yeah. Yep.
Is it better?
No. I wonder if anybody else on the chat thinks that Roy's thing is too low, the volume?
Oh,
Or is it just...
fine here. Hearing it fine here.
Are you hearing fine?
Yes.
Oh, it's probably my phone. Sorry about that.
No, that's all right. See if you can modulate your laptop volume. That might help. And then actually, I think there might be a call volume somewhere as well. All right. Well, to continue with this, guys, I'm going to show you guys a backtesting strategy that's going to help you guys figure out if a certain strategy works for you. So what you do is you take a strategy. Let's say it's an engulfing. So an engulfing means that you have a reversal candle that engulfs the previous candle. It's larger than the previous candle, and it closes above that candle. What that means is a sign of reversal. And the pattern or the strategy I'm going to show you is you go back through the charts and you look for these, you look for anything that's an engulfing candle, and you see if that pattern followed through with the way that you wanted it to, or if it didn't. And what were the characteristics and anatomies? You want to do the, oh yeah. So let's do something else. Let's do pin bars and doji reversals. So pin bars and dojis are candles that have long wicks and small bodies. Long wicks, small bodies. And so we'll go through the reversals and we'll see how many times it actually played out and how many times it didn't. So we'll start from back here. We'll start at a random place. Market came to the bottom. We saw a pin bar doji right here. And so imagine if you entered after this pin bar doji. If you entered after the pin bar doji, it would have consolidated for 1, 2, this was like 3 days of consolidation before the move actually happened. I'm just going to highlight every single one that I see, and we're going to count them out, and we're going to see how many times it actually worked and how many times it didn't work. All right, guys, so I just went through and I highlighted some of the swing highs and some of the swing lows that I saw that had dojis. All right, even right here. And so we're going to count out how many times it actually worked and how many times it didn't. All right, so bear with me. You guys see this first time? If we had bought after this candlestick doji, we would have made 150 pips profit. Okay. This next time is a little bit different. So these are some of the patterns that we start to see. The point of backtesting is not to confirm if the pattern works or not. It's to condition your mind for all the possibilities and all the different shapes that informs that pattern can take. So for example, right here, there was a candlestick doji we entered. It would have went sideways for 3 or 4 days. So what is the lesson here? The lesson here is if I enter one of these, I have to give it maybe 2 or 3 days to play out. I have to be patient with this pair. Because in the past, it's actually gone through and consolidated for a long time before it went through. So now we've noted this possibility, and we know that if it consolidates for a little bit, we don't just jump out of the trade. We have patience. Now, what does that do? What is knowing what is it called? The exceptions to these rules mean? What does it do for you? It gives you confidence and it gives you patience. When you're confident that this reversal pattern is still going to happen, even though it's not playing out exactly the way you wanted it to, it allows you to stay in the trade longer, which is really crucial. And so we go through all of these different shapes and all these different patterns, guys. Right here, we could have sold. And look what happened. We would have been wrong, okay? We had candlestick dojis that did not work out. So I'm showing you guys exceptions to the rule where it shows that the pattern is not always consistent with the way that we want it to play out, and it can take different shapes and forms. But most of the time when we see this wick, most of the time when we see these wicks, most of the time it works in our favor. And so we talk about all the time, we talk about reversal patterns, and we talk about probabilities. We talk about we don't need to win every trade or even know what the market is going to do next in order to make money. If we know that most of the time, if we see a reversal wick at the very top, if we take that trade, the majority of the time we're going to come out profitable. Does that part make sense? I know I'm going through it a little bit fast, but the whole thing is that even if this one doji or this one doji here doesn't work out, as long as the rest of them or even 3 of them work out, I'm going to make my money back. So I'm not looking to win every single trade. I'm looking to find a strategy that works most often, that works the majority of the time, and I want to trade that every single time in a disciplined fashion. I'm not going to pick and choose, oh, I like the way this one looks. I don't like the way this one looks. I think this one looks good. No. If you see a pin bar doji, you're going to have to trade your strategy. I mean, obviously with more confirmations. A pin bar doji is only one confirmation. It has to be at the top of a trend. It has to be at a reversal, a support zone. There's a lot of confirmations that we have to use together. But let's just say, for example, let's say that we only traded one thing. And it was this pin bar doji every time it hit the moving average. So every time it hits the moving average from the top, we sell it. Every time we hit the moving average from the bottom, we sell it. And so how do we do this? We go through and we see every time that it hit the moving average and we see if it responded properly. Here we would have been faked out. Maybe we could have sold. It's consistent all the way through. Became dynamic support resistance.
If you draw a horizontal line.
I'm going through the pin bar dojis that slap on the moving average. Yeah, didn't move, didn't slap. So yeah, we only had like one move here and one move here. So if that was the only thing that you traded, it's 100%. Right now, so far, guys, what we're seeing is the strategy that's a pin bar doji that rejects off of the 200 moving average. Is that the 200? That rejects off of the 200 moving average is 100% effective. And so we'll keep going. We'll see every time that price touches the black line, can we sell it? Right here. No, there was no doji here. It doesn't meet our confirmation. Ah, I see something beautiful. This rejection here and this rejection here, we could have bought here and taken profits. All right. Pin bar doji, pin bar doji. You could have bought at any of these. As long as you put your stop loss and take profit, you wouldn't have lost any money on this. So this is something, this is like a strategy that you guys can use. Find a strategy that you like, one of our strategies, like a break and retest, a channel break. Like if we have a channel and then it gets broken, something like this. Something like this. You guys can go try out this strategy. Go out and draw channels and see every time it broke, can you get in on a retest? See how far does it usually retest on average? You start to look at stuff like this, and when it actually happens in real life, you'll know, okay, the channel broke and it's coming back up a little bit. This is probably a sign to sell. You know, it's a break and retest of the channel. So these are kinds of things that you guys can start figuring out when you're back testing. But when you're actually trying to do it live and you're trading, there's a lot of things going on and you can't figure this stuff out. It's not as clear for you. This is what the weekends are for. When we have a clear perspective, we're not emotionally involved in any trades, we can really look at this information subjectively and be like, okay, how would this make sense if I'm actually doing this during the week? So during the week, I don't have to think about it. I can just do it flawlessly. That's the point of these market mastery sessions. Now, guys, put in the chat if you guys understood the concepts of this call. The fundamental concepts that we went over first were calculating your lot size and learning proper risk management so you guys don't over leverage on your account. The second part of that was a caveat to that, which is showing you guys how to do it on the trades and showing you guys a quick backtesting strategy. Put a 1 in the chat if you guys followed both of those concepts. Altia says yes. Rodney says 1. Nikki says 1. Altia says 1, 1, 1. Beautiful.
Awesome.
So somebody put in the chat real quick before the chat ends. I'm going to ask you guys a series of questions, and please not the same person answer every time. If you guys wanted to go back test, okay, what are you looking for? It might actually help. I'm actually going to type out the answer while you guys type out the answer. Rodney said it. Learn your patterns. You got to learn the patterns that happen.
Reading that story, reading the letters.
Dojis, engulfing candles, pin bars, and dojis. Exactly, guys. And that was just an example, by the way. So that's just one trading strategy that you guys can use. Another one is like harmonics, for example. You would go through and you would draw harmonics. So this is actually how I backtested harmonics when I first started, and I think it got me pretty proficient at these. Well, this one wasn't valid, but I would just go through and draw these W's, and I would wait for it to fall, and it didn't fall. If it doesn't fall, I know that harmonics don't happen all the time.
Divergence.
Stupid divergence. This harmonic, however, it worked. It sold off. So now I would just count up how many harmonics I saw and how many of those actually won, and I would see how successful harmonics are. So on this page, harmonics are so far 1 of 3. Or sorry. This one was successful. This one was successful. This one was successful. This one was not. So we're 3 for 4. I'm going to skip the bullish harmonics. We're just doing the bearish harmonics. So yeah, bearish harmonics were 75% effective on the daily between April or June of 2018 and December of 2018. All right, that's just an indication that if you guys traded these harmonics on the higher time frames, you would have been 75%. You would have been 75% profitable. All right, on your trades. So that's kind of what we're trying to show you guys is you go through the different patterns and see what percentage of these trades is profitable. Find a strategy that's actually profitable a majority of the time, and then build your strategy on that. The way you can lose trades and it won't matter because you know that eventually the winners are going to make up for the losers. Even if you lost this last harmonic, guys, you would have made enough money on the pips of these drops, on this drop, and on this drop to make up for this one loss up here. And that's why we risk a little bit to make a lot. That's kind of the main caveat to the way that we trade. All right, any questions? We're going to leave it up to you guys the last few minutes. If there's no questions, then we'll bounce it off and we'll see you guys tomorrow for hella calls.
Yes, sir. Yes, sir. My man Anish, Natoria, Althea, Lisa.
Let's see who's actually on the call. Bianca.
Yeah.
Bianca, prayers up to you. I don't know why you're getting an MRI, but I pray everything's all right, and we're praying for your well-being. I hope everything's straight. Okay, Althea says, candlestick patterns at key areas. Althea just summed up the entire call. Find candlestick patterns at key areas and learn those patterns of a specific market, and that will tell you the story of the market.
100%. It matters where it is than what it is. Right? The higher time frames obviously have a higher probability of playing out as opposed to the lower time frames.
For sure. Rodney says, I'll go practice looking at these charts first. Find a pair that you like. Seriously. So I scrolled through all the pairs and I looked for some that just looked visually appealing to me. That seemed very geometrically, structured, and they just seemed to hit, break, and retest very often. Like gold was one of those. It just seemed to work very well, the way that it broke through levels. And so I started backtesting that. And I realized that I got really good at one pair. Because when you're watching one pair from Sunday to Friday, you're going to catch every single move that it makes. You're going to start to learn the patterns. One last thing I would show you guys is you can actually put on your session breaks. So go down to your settings tool. And you can go to, I think it's a status line, appearance.
Yeah, session.
Appearance and session breaks right here. Oh, you can't do it on the daily. And it will show you the separation. And this is like the New York session closes. So what you can do is you can go through every single time the session closed and see what happened, which is really easy. This one consolidated. Consolidation, market's dead. Market's dead. Market's dead. Market's dead. Every single time the market closes, it's dead. So why the hell would you ever trade the market close? Okay, so we see what times are dead and we look at what times are actually live and we just try to trade these live times. So you look at what time this was. I can't even read that. I think this was this is London session. This is New York session. This is London session, this cell right here. This is New York session, this little limp. This is London session. This is New York session. You guys can see when the market closes at 5 p.m., it's always dead. So then you make your trading journal based on that. You make your trading goal based on that. NZD JPY, I'm not going to trade between the times of 4 p.m. and 6 p.m. So you know there's nothing that needs to happen. And the prime times are where these big moves happen. All right. So guys, if any questions, refer to us in the chats, in the members only chats, and then we'll see you guys on Sunday.
Beautiful. Awesome. Hope you guys have a wonderful night. God bless everyone for hopping on. Chart Addicts, the wave. Chart Addicts, the mission. God bless everyone.